Yeah, Matthew. That's a guy who's also got a lot of problems. A lot of problems. Decent golfer, a lot of problems. Okay. First question. Tomas. Hey, Merritt, I have a question regarding CVAs. During the last intensive, you've been using a 3-day CVA between January 18th and 20th. After a break away from it, price came back on the 2nd of February. We were balancing around lower. Around that mentioned CVA. What was your reasoning behind not cutting the CVA and focusing purely on new value made on 2nd of February? We made a POC on the prior. This is a long question. I made a POC on the prior CVA on that day, so it looked like price was not respecting the old CVA structure, but yet you continue to use the CVA. Do you think that using new value would be a mistake here? Is that type of situation? I tend to lean towards fresh values, but I'd like to hear your take on these type of situations. Thanks for your great work. I don't know what markets you're talking about. I'm guessing it's the S&P. Most people, a lot of people focus on the S&P. Oh, and by the way, guys, so we use the Q&A for the questions, but then please use the chat for follow-up, other people, peanut gallery comments on the topic at hand, whatever. Use the chat for that. So anyways, I'll just tell you this. I don't let a single day's value disrupt multiple days value. Okay. We would have to come in and form a new multi-day balance for me to alter where I see that more important higher time frame value, if you will, where that is. So simple answer there. I'm not going to let one single day, February 2nd or whatever it was, mess up a multi-day balance area. Only multi-day balance can alter prior multi-day balance. Matthew says, any reason you didn't make WDVAL bullish after the shift and hold into it? Confluence with the old composite value high too. Are you talking about today, my man? What are we talking about here? Oh, I mean, yeah. I mean, I went long today on the little imbalance there, you know. There was a fresh shift on the weekly, on the monthly, on the CVA. Like it now, granted, I've been talking about this today with a mentoring group. I talked about this today with my traders on the desk. It was, as we call, micro. Okay. So for me, when something is micro, in this case, we had some stacked references in an area, and it essentially does, it's your middle name. It's something like this on the higher time frame. On the time frame that these references come from, it just did that. But on our intraday chart over here, let's say long-term, lower time frame. Sorry, let's make this higher time frame. It does this, right? It gave us little trades. In fact, it did what did it do? One thing, a little bitty dip, and then this, and then kind of like a little flaggy thing, and then went. Okay. I realized that no one can now see what that did, but you heard me narrate it. Hopefully that's good. The point is that there was a small pullback there. It was very small. You had to be really looking for it. Order flow is what made getting into that difficult today. I felt very compromised in terms of order flow getting long the S&P at that area. It was not yet far enough into the session to where I could comfortably say, you know what, instead of the buyers being weak here, which was my read at the time, you know what, this is a passively driven day, which is what we got, right? We trended all day until we reached the destination from the DMI, by the way, right? And in fact, what did I say in the DMI? What did I say? It would be an easy trade to 44.50, right? And that's exactly what it was. It was so crystal clear. If that bearish level was going to fail, there was just no question as to, I'm not saying what would happen. We never know what's going to happen, but there was no question as to what that market would be trying to do next. And that's the beauty of understanding context to the degree at which us Nadro folks understand context. And look, okay, so maybe the haters on Twitter are going to say, you know what, Merritt, you didn't call high of day today. You're 9. You've done that 9 out of the past 12 sessions, but guess what? You didn't do it today. Now you're 9 for 13. You suck. Well, guess what, Mr. Troll hater? When you have really good contextual levels, as one of those 9 of 12 days were that I don't count towards, a high of day, low of day calling day, when you get the shift, when the level fails clearly, it gives us just as good of a trade, if not a better trade some days than the original lines in the sand gave us. Some days I come into a market with a bear line in the sand, hoping that it gets broken to the upside, because that's going to even better align me with multiple timeframes and directional biases that I have in that market. So it was nice today, just the confluence that we had of multiple timeframes shifting from bearish to bullish, which made for an easy trade with a very clear likely destination to the upside. Order flow is tricky, as I said. Let's just share this DMI screen, huh? Andrew Ryan asks, how do you determine how many tick increments to set your TPOs? Why does it change? How often does it change? Well, I don't have a, I'll tell you when and why I change them. I don't have a scientific answer for you as to how often that happens or whatever, but because that's just simply not important. I set my TPO tick sizes based on the volatility at hand. I would mess around with this chart, but because I like to, I use it, I take very specific screenshots where I haven't altered any of the axes or anything on it, just so it's pristine compared to what I said pre-market, so that we can, I don't want to change the chart. But anyways, if all of a sudden volatility really went lower, so right now, as you can see, it says 1.5 points, right? So that's 6. I have it set on 6 ticks for my TPO size. I set it that way where I feel like I see the right amount of granularity. In fact, you know what? Let's duplicate this chart and let's actually go to work on one. That way I'll feel comfortable altering it. Rename it if I know how to use Sierra's menu, which I don't. Oh my gosh, how do you rename a chart? Other. Yes, it's there. New DMI 2222. Make sure I share the right one. Okay. So let's say, for example, that I had this set to like 1 tick size. Well, guess what? The problem we're going to run into is that we have to make this so wide before we can start to see individual letters that I lose, essentially, I lose my big picture view. I can't tell what this day did or what this day did or what this day did. I see that maybe there's some balance right here. I don't know where, where lows are, where value, what I mean? This is extreme. And I think we could go to the other extreme as well, right? We could say, well, let's make it in 30 tick increments. Now it's going to look like treasuries. There we go. Wow. We're losing way too much information. It looks like this market doesn't even move. It looks like every single day is probably a bunch of poor highs and poor lows and stuff because there's not enough granularity. So somewhere in between those two extremes where I can see the full range of the past handful of days. Let's set it to 8. No. Let's set it to 4. 4 might work. 4 is fine, right? 4 is absolutely fine. There's nothing wrong with that. I can see what's going on. Granted, we've been in a tighter range the past 1, 2, 3, 4, 5, 6 sessions. So when we start to see more if we go back, there's times where 4 looks pretty good. It's fine. That's what I'm saying. There's nothing perfect. So 4 would have been fine when we were really volatile, a couple months ago or whatever. I had it on 8 or whatever, and that was needed. I think 6, a happy medium. I think 4 is fine here. Somewhere in that range is perfect. So, again, if volatility really shrinks, I will use a lower tick number to see more granularity, because I need to see more granularity because there's not enough volatility. If volatility goes through the roof, I simplify the view by making it a larger tick size, therefore less granular. And it allows me to see not only contextual market profile, but individual day market profile. So how often and whatnot, I mean, who knows, whenever volatility changes. Tamlin asks a smart question. How is the market moving with so few market orders today? So what they're alluding to is essentially delta, right? Which is, okay, we have volume, we have a trade that occurs. Was it someone who's pressing buy market? Someone who presses buy market is aggressive. Someone who presses buy market is impatient. They need to be long or they need to be exiting a short. We don't know which right now. And those people are important to markets, right? Those people, at least in the markets that I focus on, most of them, not all of them, aggressive participation typically, which is why we're having this conversation here today, because it didn't, typically drives movement. So if you have a bunch of people aggressively buying, right? Like people love to put out the age-old thing about, why did a market go up? Well, it's not because there's more buyers than sellers, right? It's because there's typically more aggressive buyers than sellers, right? Maybe larger buyers than sellers, right? So they're eating up all the size on the offer and therefore moving price higher. That's typically what moves markets. Well, sometimes you get a big hedge fund or a handful of hedge funds or big pension funds or whatever, who cares? Huge players who come in on a day, and the S&P is like this today, and it's going higher, and it's not because there's aggressive buyers. It's because there's passive buyers. It's big old participants sitting there on the bid, right? And that bid is stepping up, and price is just running away from those orders. And then, like we saw during the phase of that transition, like I talked about, where the bearish lines in the sand were breaking today, and we had a little pullback, and we ran to the target. What happened is we actually saw a lot of selling momentarily, and guess what? So you got a ton of selling, but price doesn't go down. It just barely goes down, right? Not relative to the amount of selling we saw. Guess what? That's more just passive buyers just absorbing that selling, and then we continue higher. So to the very smart question to ask about what the heck's going on in the S&P today. Today is a passively driven market in terms of order flow. Nick says, can you discuss your process for entry in terms of monitoring order flow? This morning, the hold above 44.10 per the morning plan. What were you watching with order flow? So I got in a little bit before we held above 44.10. Sorry. But that's where, as you would know, Nick, as a student, that's where I got kind of an intraday setup. And some of the references, right? The lower bear zone was beginning to fall apart. And I had the conviction at that time, let's go with this thing right here, right now. What I did not have, per your question, was order flow at my back. And it's funny that you asked that question, and Tamlin asked the question right before you. I was concerned at that time. I did not have the foresight or the knowledge, as it's impossible to. We don't predict what order flow is going to do. We can only react to what order flow is doing. And at the hard right edge, when I was stalking that long, I thought, oof, I do not like the order flow here. But I like the fact that the structural levels breaking down, that we at least kind of were ripe for a little stop run higher. Let's see what 44.10 does. And sure enough, we just pop right through it. And then it was at that point in time when that trade starts to work that I said, aha, it's no longer just, okay, buyers are weak, which should be the initial read. It's, aha, this is actually a passive day here. So you can't see it. It takes time before we can say, okay, there's enough weakness from one side of the tape and it keeps going to where we can say, okay, I get it. It's a passive day. Thomas says, hey, see tons of YouTube websites talking about entries, exits, but I barely see anything about position sizing. What are some strategies you've seen to be effective? And I keep it simple in that regard. I know there's a lot of people who will run like literally computer programming, code stuff to tell you how to optimize, risk management strategies and stuff. I've never been into all that. I know some people like, what's the name of the thing that people like from, is it Van Thorpe? I forget his name. What's that risk thing called? Not his name, Toby. What's the risk thing called? No, it's not a martingale. No, Kelly. Thank you, Mr. Lasky. It's the Kelly formula or the Kelly criterion or whatever. Yes, that's it. I've heard a lot of smart people say that that's a really good thing to do. I've always kept it simple. So let me give you some practical advice on how I see risk and things like that. I think you want to start with a couple variables. One, within any financial constraints are an obvious thing, right? But let's pretend that we're all starting out futures traders and we want to trade, let's say, micros, and we want to keep our risk as small as possible, but we do like to scale out. So we want to be able to trade 2 or 3 lots. Okay. So that's almost like a baseline type thing that I think a lot of people are going to start with. Yeah, I'm twisting off an Oreo cookie right now. You want to look at how many attempts per day you typically need to do what you do. How many attempts per day do you need? So is one trade a day enough for you? Probably not for most of us on this call. Maybe 3, 4, 5 is probably the sweet spot for most intraday folks in terms of, look, if I'm 0 for 3, 0 for 4, 0 for 5, let's call that a daily loss limit. So then take that minimum size and quantity and the market that you typically trade and kind of ballpark how wide your stops typically are and say, okay, if I need at least this wide of a stop, or let's say a maximum of this wide of a stop and this many attempts, I've arrived at a daily loss limit. That's the first thing that we arrive at. And then by knowing your daily loss limit and then how many attempts you need per day, you simply divide it, right? I was just talking with an advanced group mentoring group just before this call, and we were talking about that. The trader was giving himself 3 shots a day. Therefore, they were using 1/3 of their daily loss limit as their R value, right? Their risk per trade. And we were talking about some ways that maybe he could get a few more attempts in there. And I was like, I don't know about those kind of advanced ways. Why don't you just take your DLL and now divide it by 4? Risk 25% of your DLL per trade. Keep it consistent, keep it simple, and work on getting better as a trader and whatnot. So I really like keeping it simple. I like daily loss limits. I like give back rules with thresholds. And that's the gist of it. And I like dynamic stop placement, guys. I do not like traders who say, I always risk 2 points in the S&P. I always risk six points in the S&P. I always risk you know, 8 cents in crude oil. Good luck trading crude oil the past month with an 8-cent stop, right? And that's an extreme example, but it's case in point. You have to be dynamic with how far away your stops are based on the volatility at hand. So don't just tell me or tell yourself or whatever that you just trade with this stop. Don't do that. Okay, if you want to be like ATR based or something, fine. At least that's volatility adjusted. I like to be truly intraday market generated information based, right? I typically put stops beyond areas where I've identified a shift in momentum and things like that. And I'm pretty, I'm typically pretty tight with stops and stuff like that because that's a style thing. It's a preference. I like to enhance risk reward. I therefore lower my win percent. I typically live in the 40 something percent win percent range for any decent sample size. And I'm cool with that. Blair says, how much of a change in delta on the ES is enough to say that something changed on the tape? Well, there's varying degrees of that. So we have different ways of reading order flow, as you know from the NADRO course, Blair, that we have short-term order flow, we have contextual order flow, all kinds of different reads on order flow. So I can't give you an answer to how much of a change is a change. I would just say to very importantly segment or compartmentalize short-term shifts versus meaningful contextual shifts and know the different implications for your process and your view on a market. Matt says, what do you view as a good to great futures trader outside of consistent risk management? I don't know what that means. What do you view as a pretty good futures trader outside of consistent risk? Oh, like skills. Anyway, let me keep reading the question here. Maybe I'll understand it. When are they consistently profitable? Is that typically daily, weekly, monthly, etc.? At Apteros or previously at other firms, what type of returns on their capital do you consider good or great? More consistent traders get to kind of a magic place where I've seen this a lot throughout my experience with successful traders, where they have around 75 to 80% of their days are profitable. I think and that's, I'm talking short-term traders. I'm talking traders who take 5 to 10 trades a day, short-term traders. So therefore their runs are going to be more consistent over our basic units of time because they have more sample size. A swing trader who takes, or a portfolio manager who makes 6 decisions a year, their length of drawdowns and their ability to be down for a month or down for a quarter is trivial to them. For a short-term trader taking 5 trades a day to be down for the quarter, it means you're either in a substantial drawdown and period of underperformance, or maybe you haven't figured things out yet, or maybe something's changed and you have to adapt, right? There's several things that could be going on. Maybe on average, and these are just ballpark stuff. Everyone's different, guys. Someone who has a high win percent and low risk reward is going to have a different return stream than someone who has a lower win percent and a higher risk reward, right? Those are going to have different. So I'm averaging everyone here. Okay. But for short-term traders, losing months are rare, but they happen when you're in a drawdown pretty much, right? You have a really bad handful of weeks. And that, for me, that happens once or twice a year, on average. Anyways, those are in terms of returns. I mean, for a short-term trader, you're talking getting into the, doubling your money each year is not crazy. Some people think that's crazy. It's not. For a we're not talking about $1 billion fund here that's hard to move money and you have to trade bigger timeframes, and, or, if you're an HFT or whatever. We're talking someone who's trading, a 6-figure account or whatever. I think once you get good, I think having a goal of 100% is attainable, right? That's if you're risking 2% of the account, right? Which I think is high for a lot of people. Still, if you're risking 1% of the account, that's 100R, right? If you're risking 2% of the account, it's 50R. So it's not uncommon for traders to see 10, 12R months, right? So anyways, I those are some general thoughts on performance. 2R a week, that's very attainable for someone, arriving at consistent trading. 2R a week, sure. Yeah, people who are just have they're an ETF or a fund or whatever, and they're just trying to or even hedge funds, right? Who are very oh, I'm long short, check the box category, and they're just trying to barely outperform their benchmarks. That's a very, very different game than what I call the true form of capitalism traders. We're the closest thing left to, what was, pure pit trading, or, anyone who's trading their own account or trading prop. It's one of the last bastions of, just pure eat what you kill. It's a beautiful thing. Anyways, adding stock trading in the future, no big plans to do that, but it's certainly something that gets tossed around, and we certainly have capabilities to do that with some of our partners, in terms of what they can do for us, as well as, very sophisticated crypto, as options. These are all things that we plan to expand into, with stocks probably being the least interesting, but we may be open to that one day. What commodity futures will you not trade, and why? So things that are very illiquid, right? So let's think like lumber, or maybe pork bellies, or sugar, things where there's a big a lot of, let's call it little boys club, or whatever you call it. There's a lot of insiders, very few players, very low liquidity. It's prone to getting into limit up and down moves. Things like that are things that I avoid from a purely from a risk perspective. All right, let's do one more question here. We got a lot we didn't get to. I'm going to try to pick out a good one. Christine asked a practical question here. I find that price levels change for value high, value low, point of control, as I change the tick size for those TPO charts. Do you find that as well? Yes, of course. It's essentially rounding errors, right? It's taking what was very granular data and it's averaging it out. So therefore, some of the calculations based on that are going to change. It's just, it is what it is. It's not a problem. It's not wrong one way or another. There are purists out there who think that one tick TPO is the only way to do it. And quite frankly, I'd trade them under what's the phrase? Under a rug? I don't know what that is. But anyways, the visual aspect of getting better information in front of you far outweighs some purist who says that one tick TPO is the only way to do it because that's the true, version of it. That's like someone who comes in and says, you absolutely can't use the 100 period moving average. It has to be that 98.5 period moving average. It's the magic one. No, it's not. Nothing like that exists in trading. That's magic to the tick. None of my levels, none of my DMI zones. Sometimes they react to the tick, but that doesn't matter. I could care less about that. A broken clock is right twice a day. You're going to get things that move to the tick. What I care about is these fantastic zones that, for example, like yesterday, we had the bear zone here, right? We reacted from the zone. It gave a move, right? Risk small, reward big. Today, the zones get violated. So wherever you get involved in a pullback, you have risk small, reward big up to the next spot there, right? That's what matters. Stay loose. We teach people to stay loose with intraday tools. We teach people to stay loose with multiple contextual time frame views and kind of make some compromises here and there. And it's all part of the journey of being a good discretionary trader is ultimately learning when and where to embrace some compromise and some dissonance and be able to go with it anyways. That's right. There's no holy grail. All right, guys. Well, the inaugural Trader Tuesday is under the belt here. The recording will be posted in the community site. We kind of have two community sites. One's just for people who don't really have student access, and then one is actually a big community of a bunch of people sharing things and doing stuff. You gotta be a student to be a part of that. Why would we want people just lurking and trolls and all the crap, right? We have zero, since the inception of Apteros, zero problems in our community, right? It's a very awesome place with people who are actually serious about it. So anyways, hope you got some value out of this today. And I'm glad we got a little new tradition here, Trader Tuesdays. We'll see y'all next week.